In December 2019, a novel coronavirus emerged in Wuhan, China. Within 18 months, it had reshaped the global economy in ways that few institutions saw coming, and many had quietly prepared for. The story begins not with patient zero, but with a system. Since the 1970s, epidemiologists and public health officials had modeled pandemic scenarios. The WHO conducted exercises. The CDC drafted response protocols. But according to scholars of institutional history, there existed a parallel architecture, financial institutions positioning themselves for precisely this kind of systemic shock. In 2010, the Rockefeller Foundation published a scenario planning document called Scenarios for the Future of Technology and International Development. In it, a detailed narrative titled Lockstep described a global pandemic that would accelerate centralization of authority, surveillance infrastructure, and digital payment systems. It was labeled a thought experiment. It was treated as strategic foresight. Then in early 2020, the thought experiment became policy. Within weeks of the WHO declaration, central banks globally coordinated the largest monetary injection in history. The Federal Reserve alone deployed nearly unlimited liquidity. According to data compiled by the St. Louis Fed, this injection exceeded the combined stimulus of the 2008 financial crisis. But here is where the mechanism reveals itself: this capital did not distribute evenly. It flowed first to institutions positioned to receive it. BlackRock, the world's largest asset manager, was contracted by the Federal Reserve to manage these emergency purchases. In effect, a private asset management firm became the operational arm of central bank authority. Meanwhile, small businesses faced loan applications and delays. The wealth divide, documented extensively by the Institute for Policy Studies, did not narrow during lockdown. It accelerated. This pattern has repeated across every major crisis for 50 years. In 1987, 2001, and 2008, market shocks preceded coordinated liquidity events that benefited institutions with pre-existing access to central bank networks. The mechanism is structural, not conspiratorial. It is written into the architecture of modern finance. Central banks inject capital. Asset managers deploy it. Smaller players wait. Concentration increases. Today, this concentration is visible. BlackRock, Vanguard, and State Street collectively manage over $30 trillion. These three firms hold significant stakes in nearly every major corporation in America. During the pandemic, as documented in financial press reporting, these institutions grew wealthier while median household income stagnated. The Federal Reserve itself admitted in 2021 that quantitative easing had widened inequality. The pandemic did not create this system. It revealed it. It showed which institutions were wired directly into the machinery of state power, and which were not. The next crisis will test whether this architecture has changed. It will not have. Next week, we examine the Federal Reserve, a century of invisible architecture.